All right, welcome. Today, we're going to decode what really feels like the secret language of the market, chart patterns. We're going to figure out how to turn what looks like just a bunch of random noise into a clear story about where a stock might be heading next.
So here's the core idea for today. I want you to think of a stock chart kind of like a medical x-ray. I mean, to an untrained eye, it's just a blur, right? But to a doctor, that blur reveals everything about what's going on inside. Well, for a trader, a chart does the exact same thing. It tells a story about the health of a stock, but only if you know how to read it.
And that right there is the big question, isn't it? How do you become the expert? How do you look at these squiggly lines and actually understand the story they're telling? Well, it all starts with recognizing a few key shapes that show up over and over and over again. So let's start with the ones that signal a big change might be just around the corner.
First up, we have reversal patterns. And the name pretty much says it all. These are patterns that can signal the end of whatever trend is happening right now. So if a stock has been climbing and climbing, these patterns might tell you it's about to turn around and fall. And of course, if it's been falling, they can signal that it's about to bounce back.
So let's meet the double top. This is one of the most common bearish reversal patterns you'll ever see. The price goes up, hits a peak, pulls back a bit, and then rises to hit that same peak again, but it can't break through. It's like the stock is trying to smash through a ceiling, not once, but twice, and it fails both times. That's a classic sign of exhaustion. The buyers are running out of steam.
Now, here's the crucial part. How do you actually trade it? You see those two peaks, but the biggest mistake traders make is jumping in way too early. You have to wait. The most important thing here is step 3. You need to see the price break and close below that neckline. That's the support level between the two peaks. That breakdown, that is your confirmation. That's your signal that the bears have finally taken control. And, if you just flip the double top completely upside down, you get its optimistic twin, the double bottom. It's the exact same logic, just in reverse. Here, the price falls, finds a support level, bounces, falls back to that same support, and holds strong. It's a really bullish sign. And again, the rule is exactly the same. You don't even think about trading it until the price breaks above the neckline.
And look, this isn't just some textbook theory. Check out these real-world examples. On the Nifty 50 daily chart, a classic double top formed, and boom, once that neckline broke, the market took a major fall. Same thing with Hindalco. And then on the flip side, Genus Power and Bajaj Finance showed these beautiful double bottoms, and the breakouts above their necklines led to some really powerful upward moves. This just shows you why waiting for that confirmation is so important.
So while the double top is a really strong signal, there's another reversal pattern out there that traders consider even more significant. Honestly, it's one you absolutely have to recognize because of the powerful warning it sends.
And this is it, the head and shoulders pattern. It looks just like it sounds. You get a left shoulder, a higher peak in the middle, called the head, and then a right shoulder. Just like the double top, it's a bearish reversal pattern. But this one often signals a much more significant, longer-term change in the trend.
The source material straight up calls this a dangerous pattern, and for a very good reason. It's one of the most reliable reversal signals you can find. So if you're holding a stock that's been in a strong uptrend, and this pattern starts to appear, it's like a giant flashing warning sign that the party might be over.
I mean, historically, when this pattern appeared on the Nifty daily chart, it came right before a major market downturn. We've seen it in stocks like JSW Energy too, where a really strong uptrend was just completely shattered after the pattern finished forming. And the rule for trading it? Well, you probably guessed it. You wait. You wait for the price to break below the neckline that connects the lows of the pattern.
Okay, so we've seen patterns that tell us a trend might be reversing. But what about patterns that signal the trend is just taking a quick break before it keeps going? These are called continuation patterns, and one of the most common is the flag and pull.
The structure here is actually really simple and intuitive. First, you get the pull, which is a sharp, almost vertical move straight up, and then the price just takes a breather. It consolidates in a small downward sloping channel, and that's the flag. It's a signal that the market is just catching its breath before the next big move higher. I absolutely love this analogy from the source. Seriously, think about climbing 10 flights of stairs. You don't sprint the whole way, right? Of course not. You climb a few floors, you stop and rest, catch your breath, and then you continue. A stock is no different. The pull is that initial climb, and the flag is just a stock taking a totally normal, well-deserved rest before it continues its journey up.
Take a look at this example from the Black Box daily chart. You see that massive surge up? That's our pull. Then, notice how the price just kind of drifts sideways in a really tight range, forming the flag. The trade signal, the moment we're all waiting for, is when the price breaks out of the top of that flag. That breakout tells us the rest period is over and the original uptrend is back in business. All right, our final category of patterns is triangles. And these are fascinating because they represent a period of pure indecision in the market. The price range just gets tighter and tighter, coiling up like a spring, building up all this energy for a big move. The only question is, which way is it going to break? So there are three main types you need to keep an eye out for. You've got the ascending triangle, which has a flat top and a rising bottom that usually hints at a bullish breakout. Then there's the descending triangle, which is the exact opposite, a flat bottom and a falling top, which suggests a bearish breakdown is more likely. And finally, the symmetrical triangle, which is totally neutral. The price is getting squeezed from both sides and it could really break in either direction.
But what's really cool is the psychology behind each of these triangles. In an ascending triangle, you keep seeing higher lows. What does that mean? It means the buyers are getting more and more aggressive, stepping in to buy at higher prices each time. Eventually, they are very likely to just overwhelm the sellers sitting at that flat resistance level. With a descending triangle, it's the sellers who are in control, constantly pushing the price down against a support level that's probably going to break.
So here's the absolute key with triangles. You cannot predict the direction with 100% certainty. The pattern simply tells you that a big move is coming. That's it. Your job is to just sit back, be patient, and wait for the price to break out of that triangle. And then, and only then, you trade in the direction of that break. Don't ever gamble on the direction beforehand. You know, we've covered reversals, continuations, and triangles. They're all different, but there is one single golden rule that connects every single one of them. And this is, without a doubt, the most important takeaway of this entire explainer.
So after everything we've looked at, the double tops, the head and shoulders, the flags, the triangles, what is that one unifying principle, that one rule that you absolutely cannot forget?
Here it is, the bottom line. Never, ever, ever trade a pattern before it's complete. A potential double top is just a potential pattern. A potential flag is just some sideways consolidation. The pattern is not confirmed. It's not real until the neckline or the trendline breaks. Until that happens, you're just guessing.
And why is this so critical? Because patterns fail all the time. A stock that looks like it's forming a perfect double top could suddenly blast right through that resistance and just keep climbing higher. Entering early isn't trading based on a signal. It's just gambling on a hope. The breakout or the breakdown, that is the signal. It's the moment the chart finally confirms the story you think it's telling. So now you have the tools. You know how to look at a chart not as some random squiggle, but as a financial X-ray that's full of clues. The patterns are right there, telling these incredible stories of the battles between buyers and sellers. The only question left is, what story will the next chart tell you?